Information provided in this podcast should not be considered investment advice. Please see our website, paretosec.com/compliance, for a complete disclaimer and more information. Hi everyone, and welcome to this podcast live from Pareto's 29th Annual Energy Conference. After a mesmerizing and powerful presentation earlier today, it is with great pleasure I can introduce our listeners to one of this year's keynote speakers, Mr. Saad Rahim, Chief Economist at Trafigura. Thank you very much for your time. I know you have a busy schedule. Alongside Mr. Rahim, we have also been so lucky to get a visit from one of the most knowledgeable and energetic people I know, Pareto's oil and gas oracle, Nadia Wiggen. Welcome both.
Thank you.
Thank you.
Trafigura is one of the largest commodities traders in the world, moving 7 million barrels of oil and products every day, the largest exporter of US crude, and don't even get me started on metals. Mr. Rahim, in the book published by Javier Blas, The World for Sale, you are seen as a mysterious group of companies and, quote, have historically broken rules, unquote. To me, you play a vital role in this world, and I thought we could kick it off with trading houses' role in energy security. What is your take and thoughts on that particular subject?
Well, thank you for having me, first of all. I think, look, it's a great question. I think when you look at sort of the growth of the volumes that the trading houses have been doing over the last few years. So, for example, I joined Trafigura in 2015, right? We were trading about 2.5 million barrels a day at that time, right? So we've gone from there to where we are today, 7.5 million barrels a day. But it's not just us, it's our peers as well, you know, who have grown. And yet the oil market hasn't tripled in that time. So obviously we are moving more volumes as time has gone on, which tells you that there is more of a need for what we provide. I think the way we always look at it is really where traders come into the fore is really when there are dislocations to be addressed in the market. That's why we exist, right? If the producers could just sell directly to the consumers, then you wouldn't have any need for anyone to be in the middle. So obviously, as dislocations have increased over time, whether it is trade war, you know, that seems like a long time ago, but that was part of it. Whether we have seen then COVID, you know, the impact of the war in Ukraine. You know, these are all dislocations that get introduced into the system, and then saying, okay, well, how do we make sure that the world still gets the material it needs at that time, right? And sometimes it means actually like during COVID where we have to store it for use later, or like now where you're saying, well, we need all the oil we can get out into the market as quickly as possible. So I think there's that. As for, you know, kind of the history of the industry, I think, you know, it's all there in the book. I think for what you know, if people want to read that, I think, you know, the fact that a lot of the traders are privately held tends to be seen as, you know, sort of that it's secretive. But, you know, we, for example, Trafigura, we publish our accounts twice a year. You know, we have public bonds that are traded, so we have a significant level of disclosure. We produce a responsibility report, all sorts of things that we try and do. In fact, we even put out a publication called Demystifying Commodities, simply to try and help answer some of these questions about what is it that we do. And ultimately, we view ourselves very much as a logistics and a service company, you know, provider, and helping bridge that gap between producers and consumers and sitting in the middle of that.
I think maybe, I mean, given the situation we're in, the fact that you are privately held and run a business for profit, that is probably something the world should be very happy for today.
I mean, look, I think it is, you know, we are still very much subject to all of the sanctions and regulations that exist, right? And ourselves and our peers, and we've acted upon those very quickly as required to do so, and we continue to do so. And, you know, and I think there has been a sea change in the industry, you know, really over the last decade that has said, you know, moving away from some of the things that may have been described in the book, but to an area where now we're saying, look, again, our footprint, our involvement in the global economy is such now that this is the new reality of how all of this will work. And yet, you know, again, as we said, the world does still need to move oil around. With what's happening with Russia, you know, I keep saying, is this going to end up being, and it's a phrase I'll probably use again over this podcast, but are we seeing a redistribution or a reduction of volumes, right? And given that, again, the regulations on this are still evolving, still developing, oil is still being moved around the world, but okay, fine. If less Russian volume is moving into Europe or into other jurisdictions, that means other oil then needs to be moved into those areas. And who's going to do that, right? And that's, again, where I think the trading companies really come in.
And that's what we're seeing in freight rates around the world just right now. Nadia, thank you for joining us all. You used to work for Fibro under the legend known as God in oil trading, Mr. Andy Hall. Anything to add to what Saad just told us?
Of course, I joined Fibro in 2010, so also a bit after the period described in the book.
I feel young now.
But I think what Saad kind of hinted on or alluded to, I'd like to build on, is that the market is different now, and also it is in terms of how the rules are and how the sanctions are. If we compare former embargoes as opposed to sanctions, South Africa was fully embargoed, Iran fully embargoed. Now it's, we don't want Russian oil in Europe, but it's been pretty okay for it to go to China. It's been pretty okay for it to go to India. It was even okay for a period for it to almost go to Turkey. And now the expectation is on the product side, for example, because we are facing this significant energy security threat over the winter with a lack of gas and a lack of diesel, that oil products, refined products out of Russia can probably go to Latin America. So it's not the same thing. But what has been very interesting is that I know that the industry doesn't believe in self-sanctioning, or nobody believes that about any industry. But we've actually seen after the fallout, when there was the infamous first cargo by a very well-known major that was offered after the war. I don't want to push them down by mentioning them. That everyone has actually pulled back from it, not out of necessity, but out of a desire to explain that we want to be part of the solution. We don't want to be part of the problem. And that's where our expectation was that everyone in Latin America who is in a tough situation in this market, and some of them are US dollar linked economies, that they would just buy everything. And we're hearing rumors that maybe they won't all buy everything. And so it's a big difference. And I think it is very important for the traders to actually take advantage of finding the holes in the system and placing things, and then just communicating what they can work with and help the regulators understand how to set the rules, because they know the practicalities of things.
No, I think that's a really good point, right? Is that we, in fact, we're just again in the news, it's just public, right? But we sold a cargo of diesel, I believe, to Ecuador, and again, very much within the regulations and the sanctions that are applicable on all sides, right? And Ecuador had no ban on buying this, but then have turned around now and said, well, look, we don't want any more Russian origin material. We said, okay, then that's fine. And that is then a change in the regulation. But this is part of where it is constantly evolving, right? And when, I'm sure we'll talk about the price cap and things like that, and, how is that implemented? But when there's this level of uncertainty, it introduces a huge amount of inefficiency, a lot of sand in the gears in this oil trade. And, point I raised in the presentation for those who saw it, is that the oil market is this finely calibrated system that has evolved to this level over decades. Right?
Exactly, and that is, in terms of inefficiencies, that's obviously what we see in terms of volumes moving by sea and products going to Europe, which is a short distance from Russia, now need to take a longer term to South America or other places. But I want to hop a bit forward and say that kind of commodities historically have all been cyclical businesses. Nadia, we know that you believe that we are in the start of a serious upcycle in oil. And Saad, in your presentation this morning, you described the current market as spiker. I think it's time we debate.
Well, I mean, I'll let Nadia speak, but I think in the sense of, for me, I don't think these things are mutually exclusive. I think you can have a series of spikes that actually, when you put them together, effectively are a cycle, right? Or at least an upcycle. And if you are in a position where you're ultimately, the spikes I was referring to is that because of the underinvestment, you get to a point where prices spike to a level that then causes demand destruction, and then you come off. But because you haven't had enough time to catch up on investment, your lows, each subsequent low is actually higher. Right. So, and again, if you put all those series together, you still maybe end up in a cycle. But Nadia.
Yeah, I think that's a very good point, and it's showing the marked contrast of the effect of shale. But I would just like to bring it back to how we've seen it in previous cycles, right? There were demand-led cycles that led to huge booms, and then the oversupply, and then you had the bust, right? And then, after the great financial crisis, we finally had really 4 years of huge stability in oil prices above $100 a barrel from 2010 to 2014. At the time, I was at Fibro. At the time, Saad, you were at BG.
Mm-hmm.
And, we had heard about shale already in 2007. And by 2010, 2011, we kept hearing about, this shale stuff is going to displace West African crude into Europe. Right? And we kept waiting. And I remember sitting there arguing with the traders who were already, they wouldn't agree, for example, to buy West African crude 6 weeks in advance. They wanted to wait till 2 weeks ahead because U.S. crude might be coming. And it wasn't actually coming. And and then we ended up with these shortages. I mean, you remember this, right? And so this kept, on the actual trading side, what we kept happening is you kept seeing this wave of supply coming from overinvestment, but we were so ahead of the curve. And then, of course, it finally happened. And it changed things a lot because shale is much more short cycle. You normally start to see production with 3 to 6 months after the price hint, definitely by 18 months. And, the whole cycle could be done in 18 months or 24 months. And that is kind of the complacency we got used to. And that's where, people like Andy Hall stopped being traders because they just said, well, this isn't very fun. Yeah. How much can the oil price ride up in a few months? Right. If you believe in the cyclicality. And then I loved your points in your presentation. So I want you to describe yourself on what is the big change on the U.S. shale side in terms of the supply.
No, look, I think that's a great topic, right? And just to go back, though, I remember being yelled at by Martin Houston of BG because he told me shale would never get to 3 million barrels a day. And here we are, right? So it tells you how quickly things can change, right? And I think where, we have been used to, really since 2014, putting all of the eggs in the U.S. shale basket, if you will, right? And again, I remember in 2017, we started talking about, look, there's underinvestment in this industry, and that this is going to become a major problem because we all know that, shale, you lose, the numbers have changed, but 50% of your production in 6 months, 75% in 12 months. Okay, that's shifted a bit maybe, but the point being that you do need to constantly replace it, right? It's not that nice long plateau that we have seen. And so the more shale grows, the more you have to replace it. But what we have seen over the last few years, right, is that when prices collapsed during COVID, is that people did two things. One is that they not just high graded, they probably super graded, right? That they went and drilled out the best of the sweet spots, right? And if you're even if you're a major, but really if you're the small producer, the proverbial man and his dog in West Texas, you're going to drill what you've got, right? Yeah. And you're going to drill the best of that. And then the other thing that they did was that productivity per rig went from 800 to 1600, so double. And now is coming off because you don't have the best stuff anymore. And then the last point is you had this massive inventory of DUCs, right, drilled but uncompleted wells that you were then able to draw down without increasing rig count. Now that is gone as well, right? So we have not seen that reaction function from shale that people were expecting, which was, if you had said to people at the beginning of the year, hey guys, oil prices will be 120 at some point this year, everyone would have said, well, I'll give you 1 million barrels a day of U.S. production. We're going to be lucky to hit 600, 650 this year.
That's what I loved in your presentation. It feels like, obviously, when you're in the commodities business, you need to look at history. And maybe we'll look at history a bit too much, and it has become a sleeping pillow because everybody's waiting for that U.S. production. And as you showed in your presentation, rig count is up, Brent is at 100 to 120, and production is basically flattish.
And I think that's also why people have been a bit depressed about this market. Why take the risks if you don't get the upside? So when we talk about the cycles and the spikiness, well, you suddenly had a hard ceiling. Yeah. And we saw with COVID, you didn't really have a floor.
Right.
I mean, now OPEC is back together, so I believe we do absolutely have a solid floor. They have learned this time, for now. But you never know how long that's going to last. But right now, at this point in the cycle, I think they are absolutely intact, and they, don't have spare capacity, so they'd happily cut.
Well, if Biden is going to buy back his SPRs at 80, we have a good put option there as well.
Yes, absolutely.
Exactly, though I don't think they're going to be buying that anytime soon.
No. But also, by the way, on this, whenever anyone says, OPEC is no longer relevant, I said, well, okay, if they came out and announced a 2 million barrel a day cut tomorrow, what would the price do?
Exactly.
I mean, even a comment, or he was quoted, as we have discussed on Bloomberg, right? And it was a misquote, that it wasn't actually a quote, and that even moved the market.
Right.
Yeah,
right.
$4.
Yeah.
And this is where, when we think about the cycles, so we had this ceiling, but now, because of the underinvestment, your spikes are to the upside.
Yes.
And, the new ceiling is demand destruction. And then, however long that takes, it's not necessarily that far, because we have so much liquidity in the system that you can, of course, talk about more Saad. And you know what I mean? That then it just makes that round much of a higher. I'd like to think of it, then maybe we could agree that instead of it just being an upcycle, it is a spiraling higher upcycle. You know what I mean?
That's exactly what I think, right? And to me, I am an economist. So I come back to, well, what is the signal? The signal is going to be price, right? And the signal for more investment is price, but at a sustained level. And I think that's where you do also get in a bit of a conundrum, which is if we are in a world that has more volatility, more spikes, more spirals, right? Then how are you to plan a longer term investment? And again, maybe you do come back to shale. I can turn it on and off more quickly, but like we said, you can't just rely on U.S. shale. You have to have some sources of growth elsewhere, and that's the struggle. Where if you're saying I can't, if I look at this forward curve, it's so backwardated that it doesn't incentivize me to invest in the years out. But B, that curve may change very rapidly. How do I then bank against that, right? Let alone trying to get actual authorization for a new deep water offshore project anywhere that isn't.
Yeah, which is you need a 20-year time horizon, right,
it.
or investment horizon. That's probably what people fail to understand, that you can't kind of see oil at 100 or 120 today and make an investment decision which will start up in 27 and need to run for 20 years plus to be economically viable.
That's it. And especially given that the curve back there, if there is one, I think it's going to be more like 70, 75, right, given how backwardated you are. So you're saying, okay, well, I'm not, I can't make it work at that. By the way, we haven't really talked about it because it hasn't been a factor in oil investment for so long. Interest rates are much higher. Cost of capital is actually, this is back to being a thing, is that money actually costs something, right? So your rate of return now has had to be much higher than it has been previously.
We had a trip to Houston back in May, met with met with all the guys we should have met with when we were there in 2013. In 2013 we met with 20 offshore drillers. We should probably have stopped by some of the local shale guys and ask how much oil they were pumping out of the ground. But anyways, so lesson learned. And then they said exactly that we were like, listen, oil is at 120, and then it was upwards, right, 120, 130 on the way up, and they were like, listen, we had to basically shut the lights off during COVID, so we need to see above 100 for many months before we will make any decision whatsoever. A bit back to your point, right? And we had one investor in one of the meetings, one investor in the company. They said, okay, now we have a new distribution policy. 60% of all profits will go directly out to shareholders. And his only comment was, and the rest? Where's the rest going?
Yeah.
I want the rest as well.
Yeah.
And they're like, right now we're making a lot of money, so we're probably gonna spend some of the last 40% to give back to you, but we need to invest some of it as well. But he wasn't interested in that.
No, and I think that's exactly right. Where we're saying, a lot of these companies have come out with guidance that says we're just going to spend a fixed percentage of our free cash flow, right? So fine, free cash flow goes up because oil prices go up. Fine, we'll invest a bit more, but we're not going to deviate from that percentage, right? And I quasi joke, but this is the zeal of the newly converted, right, to the religion of capital discipline, and this is where people are, right? And this is what they've been told. This is what they are being rewarded and or punished for, right? There were companies a few years ago that announced a new CapEx program, a new drilling program, and their share price would have dropped by a third on that day.
I think you had a very good comment earlier with, I don't care about, the only thing I care about is my share price, right?
Yeah, that's it. And again, and that's what the incentive structure is, right? If you're a CEO of especially one of the large public companies, you're not rated on anything else. Before it used to be, how many barrels are you going to give me? Now it's how many dollars are you going to give me, right? And that has been the clear transition on that. And I think if those are the incentives, that's what you're going to do.
Winter 2022 is approaching, at least if you're sitting up here at Holmenkollen. It's better, it's a bit farther away if you're down in the southern Europe. But according to your boat, prices will be higher in 2023. Why is that?
For gas, I mean, look, I think it's saying that, look, there's actual enough physical gas in storage likely for this winter under most weather scenarios. If there are extreme weather scenarios, obviously it looks maybe a bit different. And that is the thing with gas. It is so much more weather dependent than say, oil. But beyond that, it is then the question of, okay, if we don't have these flows coming in from Russia, or even if they are at a reduced level, but coming in, but at a reduced level, how do you get to next winter, right? Because you're starting already, at least this coming into this winter, you're starting with low, but still, a higher level overall of inventories. If you're starting from almost nothing and you cannot rebuild, what does 2023 look like? You can take all the demand destruction steps you want, but you aren't going to get that much more LNG in. You're not going to get that much more North Sea production in. You struggle to see how that gets resolved, I think.
And to add to that, I mean, when we've looked at how low could we go, even with 10% demand destruction for natural gas demand, it gets us through this winter. But in April, we're beneath the 5-year range from 2015 to 2019, which I consider the real 5-year range on inventories, right? In addition, though, I think what you say about how much more can come in terms of flex from Norway. We heard Ulrika Fern speaking today from Equinor, their CEO, and she was explaining that, they're doing everything they can to switch, flex, year on year, Q2, 18% more natural gas coming from Equinor into Europe because, they're not injecting gas because they're just sending that, So all of these things that they would normally do in terms of maintenance, they are really trying to critically address this crisis. But if it lasts 18 months or 36 months, that you have to do maintenances, you have to do additional things. We do have, of course, at least 4 FSRUs coming on board, which will help. That can help at least say 20% of what we need to bring in. We can also have, Liz Truss said we're bringing back in Shale. So that can probably, from the start of next year, limit some of the decline rates we've seen in natural gas fields. But in reality, we're looking at, by 2040, 2050, maybe they could have 30 BCM, which is, 20% of what Russia sends in a normal year. So that is, I think, the point we really need to think about. And everyone has constantly assumed, well, the U.S. is the lowest cost producer. They have, because of the shale story, they're going to be the ones to export natural gas. They're at least reliable as a part of NATO and on that side of things, but also for infrastructure they want the same long-term contracts that the Middle Easterners producers want, that even Equinor would love.
This topic is sort of lacking. Okay, if you want reliable sources of energy, you need to give, as Equinor probably said without stating it, that we need a 30-year contract.
Yeah.
Give us a 30-year contract. We'll give you cheaper energy than what you have today.
That's the thing, and I think especially with gas, the upfront investment. This has always been the thing, especially with LNG, right? And saying, okay, are you guys going to backstop this? I mean, you notice very few European companies really invested in U.S. liquefaction plants because they said, okay, we don't really need that, and now they're, I think, at that time, maybe it wouldn't have been the best economic decision, but from a strategic security of supply, you really find yourself saying, well, maybe we wish we had done some of that, right? And brought on more capacity globally, right? But you were going to say.
And this is when we think about the medium term, right? Even in a net zero world, we think that the peak in global gas demand will be in 2036. If you look at Norway's oil and gas production profile, we've peaked well before that. If we do not include, resources that include undiscovered resources. And that is where on the gas side, we haven't done anything in terms of exploration and things like that on the investment. So if we actually want to be one of these reliable partners, and this is, again, when Equinor was, when Ulrika was explaining how they make a decision, one huge part is also the CO2 footprint. How are they actually going to produce it? So when we think about that energy transition, surely a company like Equinor should be involved in helping to provide that solution for the world. If it's not for Europe, because of course our demand decline will be steeper than in a lot of other countries that are, much higher growing populations, extremely high growing populations. So that is where they need this kind of commitment and signal from the markets.
And it seems to me that the discussion and statements, they are probably a bit short-sighted. I mean, it seems like we're all in this tech bubble where we think that, okay, an iPhone cycle is 15 months. If I want more iPhones, I can just start producing now and I'll have more iPhones in 15 months. But these are longer terms, which needs decisions today, and you will not have the gas and oil tomorrow.
I think that's the issue writ large across commodities right now, right? Is that you're saying there is this clear gaping need for this, and yet we are nowhere near these levels of investment. But even if you were to say, fine, we're going to flip the switch tomorrow, right? We need the oil, we need the gas, we need the copper, we need everything. Fine, let's go out and invest in it. You're not getting most of it this decade, right? So when we talk about that, by the end of 2030, we're not getting these supplies.
And that brings me into my final question, because I said in my intro that don't get me started on metals, so I will finish off with it instead. This is obviously an energy conference after all, and metals play an, to me, under-communicated but crucial role in the transition to renewable energy. And some numbers from your presentation, Saad. EVs consume 3 times as much copper and 2 times as much aluminium as a combustion engine vehicle. Wind consume 9 times as much copper as thermal. Still, copper balances are not where they should be. CapEx is absent. Why is that? And what are one of the biggest movers of metals globally? Perspectives on that regard.
Look, I think as much as we point out the situation on the oil side, it's as bad, if not worse, potentially on the metal side. And my shorthand for this is the key to the energy transition is made of copper, right? You are not having an energy transition without copper. And yet, when you run any sort of scenarios against this, right, we are underinvested today. And even as oil has gotten relatively shorter cycle with the advent of shale, but even some of the offshore, now copper has gone the other way, right? It is now taking closer to 10 years to bring on a new mine, and that new mine will be a third, if not more, smaller than the average mine that you used to bring on. So you need more mines, higher execution risk, you need more financing investment, all of that. Your incentive price for these new mines has gone up, and yet we're still not investing. And again, you have the same dynamic where the mining companies are turning around and saying, no, our investors are telling us they want dividends and they want buybacks. So we're going to do more of that and less of CapEx, right? Again, we are not being rewarded for increasing our CapEx. We're not being rewarded for increasing our production outlook. So that's what our investors are telling us, right? That this is what they want. And so it becomes very hard. And there, in particular with copper, it becomes where you don't really have a substitute. Fine, oil, and you can then say we can substitute gas, you can say we can substitute to other things. But copper, the closest substitute for a lot of this is going to be aluminium, which has its own problems because China's not building any more smelters and is hugely energy intensive. But that's really about it. And maybe some increased recycling and scrap, but nowhere near enough to fill this gap, right? And also I would say that there you do have a problem where you don't know really where the next set of reserves are, right? Okay, if the price got high enough of the U.S., then you could bring on maybe, or Saudi has some reserve that they say, well, okay, well maybe those will become economic. Whatever it is, you can possibly get that, but not so much on the metal side.
Those undiscovered copper resources, they are not in Europe, to put it that way.
I'd say no, but I do think that there are places that regulation could play a role. In North America, for example, to say, look, that we can encourage more investment in this. And look, for at least copper, maybe not so much because there is the copper belt, but other materials there are in Europe, right? We Trafigura are an investor in a big nickel mine and project in Finland. And we went there because, look at that, where that jurisdiction is, but then where that quality of material that is going to be needed, critical for the EV battery story, that's where we are.
And I think if we can also go back to the business cycles part of this, because now we've described a relatively shorter oil cycle relative to a longer metal cycle. So it indicates that right now, actually, a quicker solution, especially when you include things like shale, is to invest more on the oil and gas side to help keep that, the boat running and have everything moving forward so that we can actually run the factories to create the batteries. I mean, China's been shutting down their factories because of a lack of power, because of a lack of water, because nuclear power was down. They're going to start importing LNG again the way they did last year to make sure that they don't have to shut down the factories because of a lack of power, right? So we need to absolutely, I think, invest in the relatively shorter cycle side of oil and gas. And I think that, the way the debate has been, it's not even a debate. We've become so polarized that you're either in the renewables camp or you're in the oil and gas camp. And if you even mention anything positive about oil and gas, then you're obviously not in the renewables camp, I feel. I think our conference actually has managed to address it relatively well, that we've had some of the big oil companies actually, or majors or big companies, investors talk about, we have these huge ambitious renewables targets, but oil and gas need to be a part of this. And, Schlumberger's board member, Maria Hansen, who spoke in our panel this morning, she was saying that, there's an expectation for Schlumberger to ride out this wave on their core oil and gas business. That's what their shareholders expect them to do. Yes, they have a new energies investment side, but the shareholders understand that we are in this upcycle that really favors oil and gas right now. But it doesn't mean just because we do that, we don't make net zero. We can still make, for sure, 2 degrees if we do everything very quickly. That's the problem, is that everything isn't happening quickly. That's why we're not going to make it.
Well, that's the thing. But I think if you look at Schlumberger and you looked at one of the slides that was put up, right, and not just Schlumberger, but across the service industry, right, where you got 20, 30, 40% reductions in workforce, right? If these service companies were to come out tomorrow and say, look, we think we're in an upcycle, so we're going to go out and increase our hiring, and bring back those 30% people that we laid off, I don't know if shareholders are necessarily going to reward that, right? Because that's what they're saying. It's like, we'd like you to keep your core business and we will take the upside of that, but not necessarily say go out and grow that, right? I think this is where the struggle comes in.
And that's probably the yes, please both, which we obviously need in the world going forward, but which is a problem because you have the oil and gas investors who want dividend and cash back, no growth, and you have the renewables investors who obviously it's only growth. But you can't have the same. You need all of those in the same camp. Some closing remarks from you, Saad?
Yeah, no, look, I think could be very easy to look at the picture that we're painting, and in some sense look at it, it's almost a very pessimistic picture, right? Because you go, oh my God, we're underinvested and we don't have enough time, and we're going to run out of these things. And then you say, look, it is a challenge, but in challenge there is opportunity, right? And not just opportunity to make a return, but an opportunity to then say, okay, how do we think about this more holistically? How do we look at this as an all of the above problem, as an integrated problem? I always talk about it as a commodity transition, not an energy transition, right? Because I think you do need to think about how all these pieces fit together, right? So I think there's room for bigger thinking on this, right? And I think there's room for sort of maybe non-traditional actors, even in the form of governments, in the form of private investors, private equity, trading houses, whoever it is, to all play a part in this, right? But I think we do have to get creative about this, and the question is, when does that start to happen?
Nadia?
I think the last point is, in Norway, everyone cares about your oil price outlook. And we got so into the gas part of next year that we actually didn't talk about oil. That is how critical gas is. Trafigura Pareto almost forgets to talk about
Yeah,
oil,
yeah.
but not quite. So from our aspect, our oil price forecast for next year is $120 a barrel. And, on the one hand, it can be super conservative because there is so much demand potential coming back post-COVID, number one from China, number two from aviation, and the world just kind of getting back to normal, right? In addition, you have all these inefficiencies on the supply side, no spare capacity, which I know you're itching to jump in as soon as I say that, on the jumping part. And then we've discussed the $80 floor.
Yeah.
But for us to really transition, I used to think that maybe $70 everyone was happy, but they clearly weren't because we haven't seen the investments. It's $40 break evens is what companies are focusing on. Equinor's CEO at ONS said 50 to 60 is the value sweet spot. Let's see. Let's see what they sanction and what shareholders say relatively. So as a result, from that side, we need a higher, more stable oil price over $100. And I'm talking, nominal right now. Yeah. It's, like we saw 2010 to 2014, so that we can build this cycle of too much energy, which will eventually happen. Is it 2030? Is it 2033? Is it 2037? I don't know. But that's when the inefficient producers fall away. Mm-hmm. But right now, we need to have that environment to stimulate things going forward. Your view on the oil price next year?
Well, we tend not to give price-specific forecasts, but I wouldn't disagree with that. And I think the question is, what does it look like in the sense of, what is the average for the year versus what can we get to at certain points, mm-hmm. right? As in, we talked about this and I talked about it in my presentation, which is you could see a real period of weakness end of this year, start of next year. And yet you could very easily then see a scenario where by next summer, you've had zero COVID restrictions lifted in China, air travel is back, U.S. driving season is starting to pick up and the Fed is on hold or whatever it is, and things look very, very different, right? And
do you have an assessment of what the demand destruction number is? Because, for us, we thought it would be minimum $150 a barrel this year, which we saw on refined products.
Yes.
But we didn't see it on the crude side. But what do you think for like a general crude demand destruction number when COVID is done and everything is flying?
That's the thing. I think you still have a huge amount of money in the system, right? And one of the charts I showed in this presentation was to show the change in household wealth that we have seen. And I think what I come back to is, maybe not so much just on oil, but on the economic side in general, is it not demand destruction, which is what we saw in 2008, right? Was people were over-leveraged, had no savings, no safety cushion. They were underwater on their house. Their equity portfolio, their retirement portfolio had gone away. They were in fear of losing their job, right? All of that combined to say, okay, that is demand destruction. Now you're saying, okay, the labor market has never been this tight. There's been $32 trillion of wealth creation just since the end of 2019, right? Even if you take away some of that from the equity fall this year, and probably more of that will get reduced, but it's still a huge amount of money, and it's the exact opposite, right? Households, corporations have spent 12 years deleveraging, right? And so what I think ends up happening is people saying, okay, well, I'm just going to hold off until, if we're heading into a recession, I'm not going to buy something. If rates are going up, I'm going to wait till they start to come off a bit, right? Housing is a great example. Housing, you normally have about 5.5 months of inventory. You're at 1.8. Okay, you need to rebuild that up, right? So all these things are still in the system, and I think then that's where, it's a long way of saying that I think it is demand deferral and not demand destruction, I think, in this time around. And you're right, where we saw it this time wasn't where the crude price got to. It was the lack of refining capacity and gasoline getting to where it got to in $5+ And so that's probably the number on gasoline. But on crude, I think, if you just don't have the capacity, you end up with almost no capacity, and then something happens in Libya, something happens in Iraq, for example, but you still need the molecules. I don't know what the number really is.
And Russia's playing games in the oil market. Could they stir things up in Iraq? It's a serious question.
This is it, right? There's no Iran deal that appears to be happening, right? So, I think we will test to find out what is that number, right? And certainly I don't think it's in the $100 to $120 range. I think it's much higher than that.
I think we will round it off with that. And once again, on behalf of Pareto, Thank you very much for taking the trip to Oslo and to share your knowledge here with our listeners today.
Thank you for having me.
And thank you very much, Nadia, for joining me in the studio.
Thank you both.
Thank you. The information provided in this podcast should not be considered professional advice and is not intended to constitute investment advice. Investing and trading in all types of securities involve considerable risk at all times, and past performance is not necessarily a guarantee of future performance. Pareto Securities does not accept any form of liability, neither legally nor financially, for any direct or indirect loss or expenses that may arise from the use of information provided in this podcast. Please see our website paretosec.com/compliance for more information and full disclaimer.